Welcome to our presentation on which stock to choose for Mr. Manuel Rodriguez. This presentation is brought to you by B300 Financial Advisors, which includes myself, Nick Lentini, Amy Lee, Katie Lee, Joseph Lee, and Brian Lazaro. And today's date is November 18th. The case summary for our presentation includes information about these three stocks: Google, Apple, and Walmart. The information includes weighing both the pros and cons of each stock to see which stock suits your portfolio best. So first we will have Amy with Apple.
The first option is Apple. They have high revenue and gross margin. The Apple revenue are on between $63.5 billion and $66.5 billion, and gross margin is on between 37.5% and 38.5%. And as you guys see on the graph, even they have some lows after the summer, they still have reasonable valuation, and also they have huge dividend growth. However, Apple have some huge competitors such as Samsung. And here is Joe with Google.
Hello everyone, my name is Joseph and I'll be presenting you today why you should pick Google as your investment. Google is the #1 used search engine to date. That, combined with the ownership of YouTube, gives them over 1 billion users on the internet, which is basically 1 of every 2 people. Just in the 4th quarter, they had revenues of $9,686 million, which they used to reinvest in other capital measures to lower their risk of loss and increase their profits. In recent news, Google has also decided to buy out Twitch for $1 billion, which is the #1 live gaming website on the web. That, combined with YouTube, will bring subscription-based revenues, which will only help increase Google stocks in the near future. The only con to Google would just be the initial investment. They don't really have much competitors, but the fact that their stocks are so high deters a lot of people away because the investment only will bring small revenue back. But it has seen consistent and solid growth for the past decade and will only continue to grow. And here's Brian, and he's going to be presenting Walmart today.
Because last but not least, we have Walmart. As you already probably know, Walmart is one of the biggest retailers in the U.S., and one of their biggest advantages over other companies is that they could beat out their prices while also having a huge selection of products, thus making them one of the most financially stable companies out there. It's very not often that you see them operate at a loss. And for example, in the past 5 years, they've garnered net revenues of $68 billion. And just this past year, they've had operating cash flow of $26 billion. So they're very consistent, and they will be profitable in some ways. Next is that they reward their dividends very well. For example, in the past 41 years, they've consecutively increased their dividend payouts. And lastly, they know how to innovate well. Most recently, they've implemented a new program where it matches their online prices with websites like Amazon and eBay, making them super competitive. Next, we have Kitty with the final selection.
Well, Walmart is growing more quickly and remains a stable investment for several years. Walmart has steadily increased its earnings per share for the past 50 years. It posted an earnings growth of 30% annually over the past 5 years and is forecasted to do the same for the next 5 years. Walmart's current payout is 48 cents, 2.6% yield, and earnings per share of $4.78, which is more than double what it was 5 years ago. Moreover, by 2018, Walmart.com, its online store, is forecasted to increase revenue to $20 billion annually. In conclusion, Walmart is a good choice for use because it offers a stable and secure long-term investment.
Now on this graph, we have the 3 companies, Google, Walmart, and Apple, and their highs and lows for the past few months. As you can see, Apple is the most profitable and Walmart is on the bottom. And although they're not as profitable as Google and Apple, it is the most consistent. So it may not look pretty in the chart, but it will look pretty in your wallet.
Okay, we would like to thank you for watching our presentation, and we hope that our consideration of the stock has increased your consideration of our proposal. If you have any questions about what you saw today, our email and phone number is on the presentation. Thank you very much.